You know the feeling, right? You fill up your car, you do your weekly grocery run, and you look at that receipt and just think, wow, my money's just not going as far as it used to. It's frustrating, it's a little confusing, and it's happening to all of us. The big question is, why?
Well, the answer isn't just one thing. It's not as simple as just yelling, inflation. It's more like a complex chain reaction, a series of dominoes that got knocked over, starting with a major conflict on the other side of the world. And believe it or not, to understand your grocery bill, we first have to talk about global energy.
Okay, so our story actually begins right here, in one of the most strategically important and volatile stretches of water on the entire planet, the Strait of Hormuz. So what is this place? Well, just think of it as the main artery for the world's energy supply. It's this narrow little passage connecting the Persian Gulf with the open ocean. And what flows through it is quite literally the lifeblood of the global economy. So just how important are we talking? Well, get ready for this number. 20 million. That's how many barrels of crude oil and other petroleum products have to pass through this single choke point. And here's what's so wild about that. 20 million barrels. That's nearly 1/5 of all the oil the entire world uses every single day. And all of it has to squeeze through this one waterway that, at its tightest point, is only 21 nautical miles wide. It is the very definition of a bottleneck. So when a conflict broke out on the region on February 28th, what happened? Bam! This critical artery was almost completely blocked. And all of a sudden, getting those 20 million barrels of oil from the people who produce it to the people who need it became incredibly difficult, not to mention dangerous. And you can see the result right away. It was an immediate economic shock. Just look at the cost to ship oil from the Middle East to Asia. For months, it was stable, right? Totally predictable, hovering just under $2 a barrel. Then the conflict hits, and boom, look at that spike. It just shoots up almost vertically to over $14 a barrel. That is a massive, 600% increase in just the cost of moving the oil, and that's before you even factor in the rising price of the oil itself. Okay, so a shipping problem in the Middle East makes oil more expensive. That makes sense, right? But how does that make your milk and bread cost more? That's the real question. Let's trace that ripple effect right to your kitchen table. It's this really clear and honestly pretty brutal chain reaction. First, crude oil prices spike. That means the fuel that runs our economy, diesel for trucks, jet fuel for planes, it all gets more expensive. And suddenly, every single step in getting food to you costs more. You know, the tractors in the fields, they run on diesel. The trucks that deliver the food, diesel. Even the plastic your food is wrapped in, that's made from petroleum. Every single cost gets passed down the line until it lands right on that final price tag you see at the store. But wait, it doesn't stop there. There's another kind of sneakier connection that has a huge impact on our food prices, and that's fertilizer. Modern farming absolutely depends on it to grow enough food for all of us. So here's the thing. The number one ingredient for the most common fertilizers is natural gas. And guess what? The price of natural gas is tied directly to the price of oil. So when energy prices go nuts, so do fertilizer costs. And the impact was immediate. We're talking about the first week of the conflict. Prices for urea, which is a really key fertilizer, jumped 19% in the Middle East and a crazy 28% in Egypt. That is a massive overnight cost increase for farmers. And where does that cost have to go? Yep, it ends up in the price of the food they're growing. Okay, so we've got this huge supply shock from a crisis overseas. It's driving up real costs everywhere. That's piece number one of the puzzle. But that's not the whole story, not even close. To really get what's going on, we need to look at a second, really powerful force that's basically acting like a massive amplifier for all these price hikes. Now, this is where it gets really interesting. Take a look at what was driving inflation back in mid-2023. This analysis is pretty eye-opening. More than half, 53% of all price increases were coming from one place, expanding corporate profits. Not labor, not materials, profits. Now, to put that in perspective, for the 40 years before the pandemic, profits only drove about 11% of price growth. This is a whole different ballgame. And this shows the disconnect perfectly. The purple is the Producer Price Index, or PPI. That's basically what it costs businesses to make stuff. The blue is the Consumer Price Index, CPI. That's the inflation you and I actually feel. And you can see for a long time now, the costs for businesses have been pretty flat, sometimes even going down. But what about the prices we pay? They've stayed way up here. That big gap between the two lines, well, it suggests that as companies' costs are easing up, they're not exactly rushing to pass those savings along to us.
And hey, you don't even have to take my word for it. Corporate execs have been pretty blunt about this on their earnings calls. Listen to this from the CEO of Halsum, a huge construction materials company. He says, and I'm quoting here, "We have done the pricing in a very proactive way so that our results aren't suffering. On the contrary, they are improving the margins." So it's right there. They're not just covering costs. They're using this inflationary environment as a chance to proactively raise prices and actually boost their profit margins. The supply shock created the story, but this pricing strategy is what's amplifying the pain.
So what we have is this perfect storm, right? A global supply shock smashes right into this new era of corporate pricing power. And the thing is, this isn't just some temporary blip that's going to vanish in a few months. No, this is forcing a huge, maybe even permanent change in how our entire global economy is wired. So let's talk about what that means for what happens next.
You know, for decades, the mantra for global business was just-in-time efficiency. Keep your inventory super lean, rely on those predictable shipping routes, and squeeze every last penny of cost out of the system. But then, crises like the pandemic and now this mess in the Strait of Hormuz, they've shown just how fragile that whole model is. So the new buzzword isn't efficiency anymore. It's resilience. And that means companies are now willing to be a little less efficient and even accept higher costs just to build a supply chain that won't shatter during the next crisis.
And this is what that actually looks like. Instead of relying on one shipping route, companies are diversifying, so they're not totally dependent on a place like Hormuz. They're lining up backup suppliers in different parts of the world, so if one country has a problem, it doesn't shut down their whole operation. They're also investing in new tech to get a real-time view of their whole supply chain. And maybe most importantly, they're holding more stuff in warehouses, building up inventory buffers to protect against delays. Now, these are all really smart moves for stability, but they also add more cost into the system, which could help keep prices higher for a long time. So, as we try to figure out this new world, what are the things you should be watching? Well, first, keep an eye on oil futures. That tells you where the big money thinks energy prices are going. Second, watch those global shipping rates we talked about. They're like a real-time EKG for the stress on our supply chains. Third, listen for clues from central banks about interest rates. That's their main weapon to fight inflation. And finally, and this is a big one, pay attention to corporate earnings reports. Are companies still growing their profit margins, or are things getting more competitive again? That'll tell you a lot.
Which brings us back to the big final question. When your wallet feels a little lighter, when you're standing at the checkout looking at that bill, is it just because of some supply shock happening thousands of miles away? Or are you feeling the gears of this entire complex system, logistics, economics, and corporate strategy, all turning at once?
And really, that's the bottom line here. The prices you pay aren't just rising randomly, they're rising systematically. A conflict chokes a key shipping lane, which sends energy costs soaring. That cost then ripples through every part of the supply chain, from the farm to the factory. And that chaotic, inflationary environment creates the perfect cover for companies to not just pass on costs, but to expand their profits. It's not a coincidence, it's a system. And in a world where these kinds of shocks are probably going to be more and more common, understanding that system, well, it's the first and most important step to navigating it.